Welcome to our masterclass tonight. I'm Jim Sheils, partner at Southern Impression Homes. As I said, I'll be joined tonight by Austin Beck, one of our top property counselors. Austin has been with us for a few years, started in land, went into lot development, and now BTR counseling. So he helps put together portfolios. Some of you on here might already be working with Austin. We appreciate you being here tonight. As I said, Austin will be in the chat box answering questions. He's a wealth of knowledge, helping me out tonight. So please don't hesitate to ask questions there. If something's really imperative and important, Austin will stop. Again, this is a real, dialogue conversation. We're sharing principles, sharing experiences. So for wherever you are in real estate investing, just starting out, a seasoned investor, I know what we go over tonight. Some of it might be review and some of it might be new for you, but I know the principles work and they've been helping a lot of our investor base have success. So we really appreciate you joining us tonight. So we'll get started and we'll be done within the hour. But again, please ask questions and we'll save time for questions at the end. I always like to do that. I think last month we had about 24 questions in a row, and that was kind of fun. So we'll aim to, any curiosity, guys, please bring it up. We're happy to answer it. So again, disclaimer, I'm not an accountant or an attorney. We all know this. We're just here for educational purposes tonight about the real estate investing that we do and the build to rent program that we work within. My journey started about 27 years ago now. Holy cow, I don't even like to say that, where a friend of my family's gave me these two books, and that really entered my entrepreneurship. And the book on the left is what introduced me to real estate. And I was fascinated by it. I grew up right near Wall Street, about 30 minutes outside of New York. Every one of my friends was running to Wall Street. I had no interest. I didn't like it. And real estate had a certain tangibility that just made sense to me right away. And I took some crazy steps. Again, I'm young in my 20s, and I signed up for a real estate class through the Robert Kiyosaki Group for $5,000. I mean, we're talking in 1998. I mean, this was insane. People thought I was crazy. But what I learned in that first class, that 5-day class, I remember at the time it was, got me on the start of my real estate career and actually helped me buy my first property. And what it was about was not about property. It was something that I called passive income, active freedom. And I believe that, I remember sitting in Phoenix, Arizona, that first seminar, and said, if I can get my real estate into place, I can get to the good things, the important things that I really wanted to try to do with my life. And that would create that active freedom, passive income, active freedom. And real estate's been able to do that for me, but it started slow. My first deal was right here. This was a triplex in Lompoc, California. I found through following some simple strategies, the old classic fixer-upper. I bought it for $152,000. Today, it's worth about $900,000 as of like last month. And I sold it in 2004. For $570. So I did very well on my first property. And it was this property that I was able to leverage off of to actually build my my property business. Sorry, guys. Cool. So that was my first deal, as you guys see, and I did rehab it by myself. That was me. Again, my contractor friend said, don't rehab houses yourself. You stink at it. And as you can see right here, I got more paint on me than I did on the walls. On that first rehab, I think I did 2 rehabs. In the next 800 to 900 rehabs that I actually did, I hired other people to do them and just oversaw the process. So it was a good lesson to me, that first property, and a principle that I've learned from family history and from my own experience, that, guys, it's not about timing the market. It's about time in the market. My success has grown the more time I've spent in real estate. It's, of course, there is some timing to it, but it's time in the market. When you're willing to give time to the market, incredible things can happen. And one of the things that I've seen the key to wealth being is long-term buy and hold. I've done lots of different types of real estate, but what's created the most wealth for me, both cash flow and equity, is long-term buy and hold properties. And I actually learned this accidentally from my parents. My parents did not have a lot of money. They'd never earned a lot of money. And I actually helped retire them eventually. But this one thing you're seeing right here, 11 Stonehenge Road, where I grew up, they bought in 1971 or 72 for $49,000. And they sold it about 30 years later for $600,000, about an 8% year over year return. and this able to fuel some of their retirement and give them, a life that they wouldn't have had just with one piece of real estate. And taking it back even another generation, this is my great-grandfather's house that he built in the late 1800s in a little village in Ireland. It's still owned today by my second cousin. Mickey owns it, and it's still a family rental. So it's been 142 years, I think, in the family. It's obviously owned free and clear. They've done quite well with it, and I showed that they both took a long-term approach. And I thought, what if I could take that with more than just one property? And that's what I did. And from that first property I showed you, I opened my first business in Bakersfield, California. And this is where it all started, where I was fixing up old HUD foreclosures, renovating them, reselling them, working with investors, keeping them for myself. And it did good. But I got to tell you guys, my old fixer-upper model made me money, but it bankrupted my time. And a lot of you are going into this because you're trying to buy back your time, not bankrupt more of your time. You don't want a second or third job. And let me tell you, my model of fixer-uppers, it created a second, third, fourth job. And that's not what I wanted to have for me forever, for my family life, or for my investors to have that type of involvement. And everything changed about a decade ago. Again, I was about 15 years in on my basic model of fixing up old homes, and I switched to new construction. And new construction changed everything. The last decade really kickstarted me into a different phase of my life, where I've been able to travel the world, enjoy my family. Family adventure is one of my favorite things to do. Cold summers in Nova Scotia, warm winters in our house in Costa Rica, lots of travel, lots of surfing, going back to visit my roots in Ireland. It's my wife and I on the left. We renewed our vows at the Cliffs of Moher last year on just getting to travel. That was my main goal with my family, those family adventures. Real estate has paid for all that and then some. Real estate also paid for something very important to me in my life. That was being able to donate a kidney to my father. I was the only one in my family who had the time, space, and financial resource to do this. And I got to spend an extra decade with my father, which was, I can't even put a price tag on that, what that meant to me and my family. And from these experiences, I became an author. My wife and I, our latest book was a USA Today bestseller. I want to stop right now and tell you, if you don't have a copy of this book, please email Jaden@18summers.com or just let us know in the chat box. I would like a free copy of the book. We'll reach out to you after this. We're going to mail you a free copy. It's going for $22.95 at Barnes & Nobles. We'll give it to you for free for joining tonight. And in this book, we really break down some of the principles we're going to go over tonight. And also case studies. This isn't just my story, but my partner, a lot of our property counselors, our clients. So this is really important to understand the fundamentals. And it's not just about the real estate. It's about buying back your time and be able to have the space to do the things you want to do with the family, your hobbies. And one of my hobbies was to write a best-selling family book. So this all was paid for by my real estate. I can't stress that enough. All of the really memorable things and biggest accomplishments all came from leveraging off my real estate, being able to provide the financial resource to make it happen. My real estate paid for this family book that went to a #1 Wall Street bestseller. Again, never possible without my real estate. Now, what you might be saying is, well, Jim, I don't want to write a book. I don't want to travel to Costa Rica, and that's fine. But what do you want to do? We always ask this question because if you're just going for the real estate and don't have more reason behind it, then your fuel is not as great. Your desire and your perseverance is not as great. But when you really look at active freedom, we've questioned a lot of our clients. And here's just some of the things they've told us before. Simply spend more time with loved ones. On their own terms, spend more time with loved ones. Upgrade their health, being able to get back into health. Do things to improve their health that this real estate's able to pay for. Pursue their passions. So many people have said to me, by having real estate in place and having this passive income in space and some financial resource, I've been able to get back into this hobby or that hobby. Like for me, I've never had to quit surfing. Even in all these years I've surfed, I've been able to continue to pursue that passion. Maybe you did music as a child and they've picked it back up. I love hearing stories like that. Traveling worldwide. Travel is a big one for a lot of our people. They love to take adventures with their family, their friends. They've traveled worldwide. They've quit their jobs. Now, some of you might not want to do that. We have a lot of doctor investors, like with our white coat community. You have a great practice. You love what you do. You're not looking to quit your job right now, but down the road, you may be looking to sell your practice, step down from a position. And we've had plenty of clients who've been able to do that by putting their real estate in place. One of ours that we'll talk about tonight bought his plane, continued his love of flying from the Air Force and has his own personal plane now, and then retired their parents. You know, this wasn't just me. We've had a few people say, by getting my real estate in place, I didn't come from a position of money, but I've been able to retire my parents, something that a lot of people are very proud of. Now, this business venture that I'm really in from new construction, it didn't start with me. It started with my partners, Carter Funk and Chris Funk. And Carter has now retired and is enjoying it and well-deserved. Chris is still running the company, and I've partnered now in with him because we really have this mission to bring the build-to-rent new construction turnkey model to the forefront. We think that it's done more good for real estate investors than any other model out there. And we really have the receipts to show that. And it's not just Chris and I or Austin. There's an entire team of us that continue to make this happen day in and day out. And what we've done is we've built an investor community that focuses on new construction, you know, not only through our teaching seminars, our live tours, our brainstorming sessions. If any of you have never stopped by our office, we highly recommend it. We just had some people there today with us. Again, and this is the growth that we've seen. You know, this was our old office, you know, starting about 10 years ago. And our new office as of last year. We've started to upgrade our systems. We've started to upgrade our volume. We're all through Florida. And we have a number of exciting things happening for us and our investors. And our company was built by investors for investors. This is such an important thing. And it might sound simple, but if you're working with a real estate investment company, do the principals, do the founders actually invest in real estate themselves? And if they don't, it's very hard to relate to the mindset of an investor or get the success that an investor really wants. So our company was built purely by real estate investors for investors like you. And what do? We work with wealthy and ultra wealthy people to help them build successful rental portfolios for long-term wealth. That is our goal. That is our mission. And that's what we aim to do every day. And the model that we stick to make that happen, we do affordable new construction, so workforce housing in affordable growth markets with low interest rate mortgage financing. This is key, and we'll talk about that tonight because that helps to ensure your cash flow right off the bat. I'm sure a lot of you are out there raising your hands and going, hold on, Jim. I know that mortgage rates have gone on a spike upward for the last 2-3 years. That's true. We actually have a way around that. And of course, to make this all work, you got to have good property management in place. We'll talk about that as well. So there's really only 3 parts to a successful build-to-rent turnkey company like ours. You got to be able to build the property right for your people. You got to be able to finance it right. That means find great mortgage financing along with great insurance premiums. And I'm sure some of you are saying, wait, Jim, I heard you can't get insurance in Florida. We're going to go over that tonight. That's absolutely not true, especially with new construction. And not only build it right and finance it right, you got to be able to manage it right. And all of these things, if you don't have them in place, the build right, the finance right, the manage right, can take you a lot of time, effort, headache, turmoil, and even financial loss. Our job is to make sure all of these are done for you in the best way possible. And it shouldn't take you more than an hour or 2 a month to oversee your rental portfolio working with us. And again, as I said, property management is one of the most important things. I remember a mentor of mine saying to me almost 25 years ago, look, Jim, if you buy real estate and don't have management in place, it doesn't matter if you get the property for 50 cents on the dollar. What matters is you have management in place, because even at 50 cents on the dollar, you could lose money. And that has always stuck out with me. I know that because when I left California and came to Florida for the better fundamentals, leaving California was the best thing I ever did real estate investing wise. I hired and fired 4 property managers until I met Chris and Carter and Suncoast. And they managed my personal portfolio and did a better job than I did. So what is our sweet spot? So the sweet spot that we found to work, not only for us, but again, this is some of the largest institutions, family offices out there with large amounts of money. What are they doing? I like to follow them. And this is what we provide for them and our investors: single family homes, duplexes, and quads. These are the absolute building blocks of the wealth that we create. And it's not a complicated menu, nor does it have to be. These are what are in high demand, low density, and have great historical returns. Now, where do we build these properties? Well, we are very heavily invested in Florida. That's our main focus at this time, although we are branching into areas like Texas and Tennessee and North Carolina. but Florida is our main focus. And you'll look at this and notice we're not offering in or building in Orlando. We're not in Tampa. We're not in Miami. Those markets we feel were too expensive, went up too much through the pandemic growth. We want to buy in affordable second tier markets where there's still appreciation happening, where there's still rental growth happening. And these are the markets that we focus on to build those types of properties. And all of those markets that I'm explaining, this is something you definitely want to remember. There are 5 factors that we look for in order to go into any real estate market and be able to build our new construction turnkey rentals. There has to be economic growth. There has to be population growth. There has to be affordability. Now, some of you have probably watched prior podcasts or webinars with us. This is my word of the year: affordability, workforce housing. We're on lower supply of it. It's needed. And also the affordable properties are what are remaining safe. The high-end properties, that's where you're seeing some dips in the markets. We want to stay affordable. And along with affordable, we want to stay desirable. You know, are you able to walk the streets at 9 o'clock on a Friday night to the properties that you own? That's one of my key requirements for me to invest in real estate or for investors to invest. Also, if you look at it on a bigger scale with state by state, desirability for a landlord investor is, are there good landlord laws? You want to have that desirability of not only the area, but the landlord laws to support you. And obviously the last one, supply and demand. We want to go where the markets are growing so much. You have both houses that are in shortage and people that are moving there. So those are the areas that we look for. We have over 900 million in asset management, 56 million annual recurring revenue, 185 million has been created in equity in just the last few years for our investors. We have over 1,000 active current investors. 9,000 units have been developed, over 10,000 residents being housed, over 120 people on our team, and that grows weekly. And it is a minimum investment to get started building a rental portfolio with this, guys, for $80,000. Now, if you have less than that, our property counselors can give you some ideas of where to get started. That's where I had to get started. I wouldn't have been able to work in this. But in order to work with one of our property counselors and our turnkey new construction system, you do need a minimum of $80,000 investment to really get the ball rolling. Now, we also have 5,000 lots in Florida that we plan to build out using that simple model, and that will be done over the next 5 to 7 years. Now, what kind of results have we gotten? Well, let's look at this real quick. If you had invested $250,000 5 years ago in the S&P 500, you would have gotten a return of just over 10%, which is a great solid return. If you had invested in a good real estate fund, you would have earned a little over 13%. If you had invested $250,000 though in our turnkey build to rent system in Jacksonville, Florida, you would have earned over 69% annually year over year on your money. The numbers don't lie. And I always tell people to look at this chart closely, because the reason that people come to us to raise capital for their real estate fund, like you look at in the middle, again, they offer us a great return. If they're making us 13%, they have to be buying real estate that makes a lot more than that. And that's why a lot of them come to us to raise money, but then go out and own the real estate themselves. And look, I invest in all 3 of these here. But what I'm encouraging you to do is don't shy away from the one on the right. No matter whether you work with us or not, my biggest wealth has come from holding my own personal real estate. And we encourage you to do the same. These numbers don't lie. So wealth, independence, and security are not just the products of work. If you look at that last slide, they were investing. You know, a paycheck can stop suddenly, and you cannot keep up with what investing can do, positive investing, by trading hours. You know, it's finite. That's a finite resource, the hours you can work for those dollars. Investing is really the only way to get ahead. And there's 3 different types of investing in our real estate investing arena, really. The most main one you hear about is the fix and flip. Now, this is where I got started. You get an old property, you fix it up, and you sell it, and that's a great way to get started. But again, that's where my time was bankrupted. And again, you're trading time for dollars. You're not really being able to get something long-term or passive. The second level, the enhanced level, is do-it-yourself landlord. You go into your own backyard, you find your own realtors, you start making your own offers, you do your own inspections, you fix up your own properties, you manage it yourself. This can be a great way to get started. This is where I got started, but it's also the area where I bankrupt my time. Some of you might have time to get into that. Other of you say, nope, those numbers don't work in my backyard. I don't want to have a second or third job doing this. That's not for me. And where we stick to now is what I call turnkey real estate 2.0, that engaged level. That's where we focus right now. So turnkey real estate, this is when someone goes in, gets a property ready for you, gets you help to get financing, and manage the property long-term. That's what we offer. And the reason I call this 2.0, we used to do this with old fixer-upper properties. That's what I worked with in the first 15 years of my real estate career. We only do new construction now. New construction has way outperformed our older property model. After doing a few thousand of these, we can say that very confidently, and that's what we focus on for our people. So without money working for you, you'll never be able to stop working for money. And again, that's why I encourage you, action has to be taken, whether it's us or someone else. Time in the market for real estate, the right type of deals with those 5 fundamentals is how you can really start to accumulate wealth and passive income. So even if you're trapped in the good income, it's hard to build wealth. It comes from setting a growing asset base in motion. And you can focus on accumulation while still extracting cash when needed. This is called refinancing, cash flow. That's why I really, really love my real estate. Asset owners finish ahead. So we want you getting to that deeper point in your financial career where you want to be. Asset owners are the people that get there. So let's look at Tom. Tom has worked closely with us for years. He's one of the ones who he is a former Air Force, loves his airplane. That's who bought his airplane. He did not want to have a lot of involvement. He was running a large mortgage company at the time. He wanted us just to take care of things. He wanted boring. Within 4 years, he had over $1 million in equity and almost $12,000 in cash flow. I got this Facebook message from him. We were talking about family back and forth. And if you look at the bottom here, on July 1st, he said, this was 2022. He said, I retired from Fairway Mortgage. You played a big part in allowing this. Thank you. And there he is flying his plane. He says his last rental that he bought pays the payment on his plane. So these are the stories that we love to have. And where did it start for Tom? 1 duplex in Punta Gorda, Florida, initial investment, $88,000. He went into 4 more properties and then 3 more after that. And he accomplished where he wanted to be. Now, there are ways that Tom was making money off his property, or I've made money off my property. It's in these 5 ways. These are the 5 ways to make money. Appreciation, leverage. Now, a leverage is a very interesting thing. If you buy $200,000 worth of stock, you're normally paying $200,000 for it. You buy $200,000 worth of real estate, well, you only have to come up with maybe $40,000. That's what leverage does. Leverage allows you to up your return by using leverage. Debt pay down. Every month that goes by, my tenants are paying down my mortgage on my property. And that is something that a lot of people leave out when they're estimating their first cash flow. But debt pay down, and especially as you go down the years, like I said, time in the market starts to accelerate. Every month you're paying down more and more principal of your loan. You're not, your tenant is. And that's another way that you're accumulating your wealth. Tax benefits. We won't go into them tonight. Last month, I did a whole webinar on this about depreciation, 1031 exchanges. It's an amazing way to get a tax preferred rate on your taxes for like cash flow, and then 1031 exchange, refinance and cash out tax-free. The tax benefits for real estate are incredible. And then of course, number 5, cash flow. You're renting the property, all your expenses are paid, and you pocket money. Now, these are all important. I think a big focus recently, especially with turnkey real estate, has been on number 5, cash flow. And I really appreciate cash flow. I love cash flow. However, my main focus has always been number 1. That's where I've made the most of my wealth. I've made way more money planting seeds in the right market and holding long-term through value growth, which real estate historically always has, than I have for cash flow. And I will always sacrifice a little bit of cash flow for a better area that has better fundamentals for appreciation. So let me give you some common pitfalls of real estate investing. First one is short-term thinking. Again, like I said, guys, it's time in the market. And a lot of people will say, okay, I need to have this retiring me in the next 3 to 6 months. Or, okay, I'm going to hold this property, but no longer than 12 to 18 months. That's very short-term thinking. And the most successful real estate investors that I know that have spanned, 5 decades in this game don't look short-term. They're thinking long-term. They're not looking to jump out of properties. They're not looking to, again, have a short-term commitment. They're looking very long-term. When you're thinking short-term, it's very hard to actually start to accumulate and see those growth patterns and the market working with you. The next one is do it yourself. A lot of people are getting on the internet now. They're looking around for possible properties. They try to do it themselves from afar. This is very popular now. They find a fixer-upper and they're trying to figure out, is the neighborhood good? Can I get people to fix it? Who's going to fix it? Gosh, I don't even have a manager. I'm going to try to manage it. The do-it-yourself for people who are busy professionals, they're successful business owners that want involvement in real estate, but not that second or third job. This can be very dangerous. Yes, you can absolutely, on a do-it-yourself strategy, maybe save time and money doing it yourself. It can also go the opposite way. And I've seen that happen. So a lot more people that I've seen, especially when they're investing out of their own backyard, do it yourself can really put you behind. Chasing cheap. So the turnkey real estate investing model has really had a very bad positioning where the marketing angle is always find something really cheap in a questionable area. I got to tell you, this is one of the worst combinations that you can do. A so-so property in a so-so area, cheap because it's cheap. Man, have I made that mistake. And I talk about that in our book. Chasing cheap can be a very dangerous thing, and it can get you in a lot of trouble. I would rather own less of better quality. That's been my biggest lesson in the last 26 years. Own less of better quality. Own less of better quality. I own 80% almost less property than I do now than I did years ago, but I have more equity, more cash flow than I ever have. That's because I stopped chasing cheap and looked more at high quality. It's been the best move I've ever made. Misdirected charity. Now, this is something for a lot of new landlords. And again, this is why I love to have other people manage my property. I don't like to manage my properties. I have a property manager do that. I have Suncoast do that. Misdirected charity. What this means is, this story goes back to my starting days in California. My first 5 rentals, I took more excuses than I did rent payments. And it almost bankrupted me because I was still having to pay my mortgages, but I wasn't collecting rent. And what I learned was, as I invested in real estate, I give to a lot of different charities. I've talked about them on other webinars, that if I gave charity to my rental properties, I couldn't give charity anywhere else. So I got very clear that I'm very supportive of certain charities. I'm very supportive of my real estate. I don't combine the two. And I highly recommend you, wherever you go as a real estate investor, whatever stage you're in, ask yourself, am I confusing my rentals with my charity work? And I would highly encourage, don't misdirect that. Keep the two separate. Wrong partners. This is something that we've learned in any part of life, whether it's friendship, marriage, financial advice, real estate, accountants. If you have the wrong partner, you're going to put yourself in trouble. So you want to get with the right partners, people that have track records, people that have receipts that they can show you on the success they've had, and they're enjoyable to work with. I mean, life is too short to not work with people we actually enjoy interacting with. At least that's what I've come to in my old age of 50. So what's our plan for 2025? Again, affordable new construction in affordable growth markets with low interest mortgage financing to help ensure cash flow. This is what we're about, and we got to put the world-class management in place for you. Now, savvy investors use proven systems, strategies, and guidance to make money in real estate by producing repeatable results. This is really important to know. If you're wanting excitement from your real estate investing, I highly recommend instead you go bungee jumping, you go on a river raft ride. That's where your excitement should be. What I learned years ago is I want my real estate to be boring, predictable, and growing at that steady pace. I don't want excitement. I don't need drama. The TV shows convince you want that. That's not what you want. You want simple, repeatable results. That's why we do the same type of properties over and over and use new construction. Build it right, finance it right, manage it right. Okay, let's do another one. Build it right, finance it right, manage it right. Build it right, finance it, manage right. This is all we do, guys, over and over and over. And what I've learned is if I cannot explain the real estate niche that I work in one sentence, then I'm not a good real estate investor for myself, for you guys, or for our company. So we stick to these fundamentals, these 3 things. And part of that, as you guys saw, was the financing right. Financing, as you know, of June of 2022, the interest rates have just started going through the roof, right? We haven't seen these kinds of climbs since I think probably the early 80s. And that actually does affect real estate. We know that. However, we're in a very good position with ourselves for in-house financing. We have our own mortgage money that we actually provide to our clients through a lender at rates 3+% lower than what your bank might offer you. And these are some actual rates right now. 3.75%, 25% down, 2 years of free property management. If you don't want a 10-year ARM and 30-year fixed, well, we can give you a 30-year AM, 30-year fixed at 4.25 with 2 years free management, or 4.75 with 1 year of free management. Go through this with your property counselors. Again, if you haven't done a call with them, it's a no obligation call to really break into how do you guys get your financing done? How do you get such good insurance rates? Go through these things and see the numbers that we can get. And I recommend you test this with your banks out there. Call them, see what their rates are at. I guarantee it's about 3% higher. Again, all of these properties have to fall into that economic growth, population growth, affordability, desirability, and healthy supply and demand. Guys, if you don't get anything else out of this today, if you're looking to be a successful long-term buy and hold investor, remember these 5 things, because when you get all 5 of them working for you, incredible things can happen. Now, let's look at population growth. One of the first things, we are very heavily invested in Florida. We're not doing anything in Alabama. I like Alabama. It's a pretty area. It's part of the Southeast, but we decided not to go there. This is why. When you look at these Fed charts, especially from 1980 on, you can look at the growth population in Florida. The red line has been staggering, unbelievable. And population growth fixes problems. It just does. When you're trying to sell stuff in a store, rent real estate, population does incredible things when it's growing. And when it's not and it's shrinking, well, that can be a really dangerous situation. And for us, there's not enough growth in that Alabama population for us to want to put our money or your money there. So affordability, remember what I said, affordability, that's the key word, that A word. This is a really interesting stat that I came across a few months ago. The Sunshine State here in Florida only has 25 affordable rental homes for every 100 low-income renters looking for it. Think about that. That is incredible. So for every 25 homes, there's 100 people wanting to rent them. And people say, oh, I heard properties in Florida aren't renting so quick. Well, one of our key markets I know we'll talk about tonight, Ocala, Inverness, Citrus Springs, we're renting most of those in under 20 days still today. Why? Because we're sticking to that affordable market. We do not build high-end luxury. We also don't build to the toughest areas in wherever we're investing. We go to that workforce housing priced just below the median. This is what they're talking about, and this is where the demand is. Good for us. Most of the national home builders, they don't want to build this. There's not a big enough margin, not a big enough spread. And the US overall, guys, this is why I say don't listen to the media. They're always telling you the wrong advice at the wrong time. Here's the bottom line. When it comes to rental real estate, we are 4.5 million homes short for the existing people we already have here. That's a staggering number that's going to take years and years to catch up with. So supply and demand, this is something too that I watch very closely. These are Fed charts from the Federal Reserve, and this is a little bit harder to read, but this is the supply and demand on permit issuing. And if you look at this, why I'm bringing this up, if you look in February of 2023, there was an absolute peak and then a complete downward spiral of available permit issuings that took place. What does this mean? Well, this means that it takes about 1.5 to 2 years to go through inventory at these times once it's permitted. And then after that, you have to, it takes a while to reignite, to restart the engine, because you can't just build a widget. You can build a widget in 2 days. A house, there's a whole approval process that you cannot speed up. You have to go through very formal things, and it takes a while. So what we're seeing from this chart, what it basically says is we are probably about mid this year to Q3, Q4 of this year, going to be seeing a supply shortage in our main markets of Florida. Even with us building as fast as we are, with the population the way that it's growing, and with so many people holding back on issuing new permits because the rates were going up, all these smaller builders pulling onto the sidelines, we're filling at such a quick pace. What's on the market right now is going to get gobbled up, and we will have another housing shortage. Not as bad as what we had in 2021. However, it will be there. And what happens in housing shortage times? Rents go up, values go up. Also, market summary, supply and demand. This is something that I always like to look at. Supply and demand is something that helps control the real estate market. And again, there's been a lot of news out there, and I have friends call me all the time and say, well, where's the market at now? I heard there's so many houses on the market in Florida. There is in some markets. Some markets are just about the same as a normalized market was before the pandemic. So this right here is Jacksonville, Florida. If you look at this in 2019, December of 2019, they were sitting right around about 22,000 homes in the Jacksonville greater area, the number of listings. Today, we're looking at about 24,000 homes. I'm sorry, that top line, that's for the whole state of Florida. Looking at that, we're at 24,000 homes 5 years later after a huge population burst, which means we're at a pretty normalized market level right now. 2019 was a very normal market. 2021, we had no properties available, so it went way down to an unsustainable low, and now it's gone back to a normal level of 2019. We feel really good about that. So again, guys, of course, it's important to look at all these things, but timing the market cannot be all you look at. Time in the market is important. But if you do want to look at timing in the market, I recommend you look at prosperity in the age of decline. I've been following ITR economics for many years. You guys have heard me talk about them on the videos and some of the podcasts I'm on. That book helped formulate the model we have today and the new construction that we do today. And here's their chart just from a month ago. If you look where we're at, they do all of the main industries: non-residential construction, medical, consumer, new orders, foreign, financial, wholesale, trade, production. Look there in the bottom middle, housing. Housing has gone through what they consider a deeper recession, which in all comparison was more minor, but they do consider it a recession for where we are at right now because of all the properties that have stopped being built, the interest rates jumping, and what they're seeing is we're about to go into another upswing. So I want to be a part of this upswing. You want to be another part of this upswing that we believe we're going to see for at least the next 4 to 7 years coming ahead. So again, our plans: affordable new construction, affordable growth market, low interest mortgage financing to help ensure the cash flow. So let's look at a property real quick. This is a 3-bedroom, 2-bath property in Ocala, one of my favorite markets this year. In fact, I called Central Florida my main focus. I love all the markets we invest in, but this has really been my eye of focus for a lot of our investors. Why? Because the buy-in prices are the most affordable that we build in. Again, you're still building for $269,900. I mean, that's most people are going, how are you still doing new construction? Well, again, we do have volume discounts with the volume we do. We're able to get you this best pricing with the best mortgages. And I want you to look at one of the numbers here. You see what your mortgage is, what your taxes are, what your insurance is. Let's look at that insurance number for just a minute. Now, that's your monthly insurance for full coverage on this single family home, $62. $62. And a lot of people go, gosh, I thought it was going to be $620 a month. No, when you have new construction model, the way that we build, where we build, our insurance premiums are very fair and still very easy to get through our insurance carriers. And we give the first 2 years for free. So with our 5-year hold, which you can go through exactly how we get these conservative numbers, we're aiming for a $135,000 profit for our investor with a starting cash flow of $375 a month. Duplex. I love the duplex model. You can put these in nice single-family home neighborhoods with a lot of pride of ownership, but you can get 2 families that really need something more affordable to live there under one roof and up your rental return. And they're also resellable down the road to either another investor or a first-time home buyer, because that house hacking of people living in one side or renting the other has become very popular. Again, you're looking at this for under $400,000. So basically, 2 properties for under $200,000. Again, the insurance, you look at that again, $92. You do have to include lawn care for duplexes because you don't want to demand on the tenants to do that. They don't have garage access in most of ours, so we want to get that done for them. Property management's free the first 2 years. This is going to allow our duplex on our conservative aims to hit a $210,000 return in that 5-year hold period with a starting cash flow of $700 exactly. So these, again, are what we aim to build the wealth of ourselves and our clients with. Our most successful clients, our most successful investors, they own 3 to 8 properties. That's the average secret levels that we see to get to. Now, we've had people go up to 25 properties, and we've had institutions buy hundreds of properties or build hundreds of properties for them. But the most successful core of investors we have, they build a portfolio of 3 to 8 properties. normally a combination of single families, duplex, and quads. And that becomes their solid soldier of offense and defense for their financial future, for their generational wealth, for their cash flow, and for their equity growth. Here's Adam Hamilton. Adam was an experienced investor in Salt Lake City, Utah. He couldn't make the numbers work anymore. He didn't want to leave his own backyard, but I started working directly with him. He worked for a mortgage company, so he saw a lot of numbers around the US and liked what we had. He went into 2 properties, went into another 5 properties, but another 5 properties after that. And within a few years, he had over $21,000 in cash flow. He was doing deals outside of us in our area after that. We support him with other things. We've developed a great friendship. And it's great to see his wealth has grown. That's not only in cash flow, but nearly $3 million now in equity increase in the properties that he planted. Adam was a more extreme case. You might say, I don't want to do that many properties, and that's fine. But I did want to also show what can happen if you really want to accelerate into it. It is possible. Or again, you go for our model between 3 to 8 properties. That can get you where you need to go. So asset owners win, guys. Please remember that no matter where you go on your journey of financial freedom, it's when you own assets that you win. Trying to keep up with job security and just paychecks, it's very hard to do, if not near impossible. So let's look at this. Again, this is one of Austin's recent investors from our white coat community. I believe he might have just closed on a second property today. So congratulations, Asraf. Again, he's gotten to get a taste of our entire team, not just Austin giving him the guidance of which properties to choose, but our property management, working with our lender, our closing department and title company. And it's no bigger compliment for someone to buy one property and then go on to buy a second one within a few short months. So great job on that, Ashraf, and great job, Austin, for making that deal. We love our white coat community, and it's so rewarding to see this grow because so many doctors get tied up in their practices. They're not exactly sure how to do what we do on their own. And then we just make things click. And we do that without the extra long hours, without the risk. Again, we love working with them. Mina Goodwin, she is a doctor as well, infectious disease doctor in New York. Very successful. She doesn't want to retire. I don't want her to either. She's a great doctor and has a young family, but she wants to be able to supplement her income down the road. Amina's on a great start of that. She started with 3 properties, went into 2 more properties after that. Her total cash flow right now is reaching about $6,000, and her cash flow, her equity, almost $800,000. So she's got a long way to go. She's going to look at that time in the market. And I believe that she's going to continue to have a lot of success. And when she decides to step out of her practice, well, she's going to be able to do it, I think, with a lot of comfort and confidence. So why should you join our investor community? If you're not in our investor community yet, guys, you need to get there. We're always sending out educational videos and market updates. It is a done-for-you program. I so wish 25 years ago, I had the guidance of one of our property counselors or our PM team to be able to put myself into a better trajectory. I had to learn a lot of headaches, a lot of lessons, go through 2008 of the wrong properties to own the right properties. And we've been able to really do a done-for-you program now where you're down to 1 to 2 hours a month to own your own successful portfolio. That is a huge, huge benchmark we want to hit for all of our people. We hold your hand through the whole process. We want you to be a part of it and educate through the process and never on your own. We have that simple aim: build right, finance right, manage it right, ask questions around these 3 things. They're so important. These are what we want to bring to the table for you. It's an ongoing coaching with ongoing support. Some of our counselors have been building portfolios side by side with investors, those 1,000+ investors, for a decade, sometimes longer. And we want to continue to have those support systems, not only on the market updates, the property counseling side, the property management, but be a part of your lives. And we support you for the lifetime of your properties. A lot of you might say, well, you're going to be doing it a long time because I'm going to pass my properties down to my kids. I get it. That's some of my plans with some of my properties, but we plan to be here forever long that lifetime is. One thing I did want to invite you to, besides make sure that you go into the chat box, you want a free copy of the book, Jaden will get that out to you. Again, it's gotten a lot of good press, a lot of positive feedback, I think, because it is so raw, tells the real story and the real principles. Start with the book, come join us on a buck store. I remember the saying, you can learn more in 1 day in the field than 30 days in the classroom. We just had one last week where we had a dozen people with us going through the market, some existing owners with us, some new, and we had a great time. And this is something that can really get you to see the projects, the market, our new office, meet our team, really see how the mechanics of our business and our properties work. Going to give you a lot of level of comfort. And it's always nice to visit Florida, I think. So seats are limited to this. We usually cut it off at about 15 to 20 people. So book your spot and a property counselor will follow up with you on that. So next steps. First thing, go to Southern Impression Homes, request a call, book a one-on-one. If you haven't done this with your property counselor, you're cheating yourself. There's no obligation. They've done this for so many investors. There's such a great track record. Do this. Learn about your financial position, your growth potentials, your growth strategies, the type of properties. It's a great way to learn whether you move forward or not. You're cheating yourself not to do this, but it is the first step in enjoying that passive income active freedom. So I want to make sure we save a few minutes tonight for questions.
Yeah, Jim. So the last point you touched on was one of our first questions from Paresh out of Jacksonville. What best ways to learn more about SI programs and markets that they build in?
One of the best ways to learn about SI is make sure you're part of our newsletter and our twice a week emails. We're always sending out market updates, hot properties, new videos, new podcasts I've gone on. Our YouTube channel is a great way, Austin, as you know. We've been told do more video. So we're out in the markets, we're discussing tariffs, we're discussing our insurance premiums going up or down in Florida, our taxes going away for properties in Florida, what's happening with the overall Fed rates. We discuss all these things. In the videos, we also get live and into the properties so you can see what is the quality of the properties that we build, what's the quality of the neighborhoods, what's happening in the overall economy and the markets we build in. So YouTube's a great way to start.
Absolutely. So I had a question from Gary and Kelly who came in to tour from New York today. They were curious, what is the Florida eviction process like? Obviously, it's a lot different in a state like New York.
Yeah, sorry, nice people today. I had friends in upstate New York during the pandemic. It was very, 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 very hard to evict, and that's a tough thing. And I know a little bit about that, growing up in New Jersey and then investing for years in California. I will never invest in a non-landlord friendly state for myself again. It's just too risky. If my mortgage is due every month and someone decides not to pay, I have to be able to get my property back to start renting it again to cover my costs. So in Florida, you can evict within a few $100s in about 40 days. And so that is a big change for me from where I was in California, where it'd be several $1,000s. And it could be several months. Some areas in California, it could be up to a year. And that's just too detrimental. So one thing that I do like comparatively, and I'm not trying to pick on certain parts of Illinois or New York or California, some that I know, Jacksonville and especially Florida are one of the best for faster evictions.
Yeah, that's great. The investors have a ton of comfortability with that. So one other question that I was asked was, other than the mortgage, what else would the investor be responsible for? Who takes care of the water? Who takes care of the power, Wi-Fi, things like that?
Yeah. So all of those things go under the responsibility of the tenant, especially with single family homes. They're going to pay for water. They're going to pay for utilities. They're going to decide what kind of internet they want. That's never on you. That's on them. The only thing, like with owning a duplex, you're going to have some lawn maintenance. Or with our quad communities, you're going to have to pay for the HOA fee that's monthly to help keep the grounds nice. But the good news is for single family homes, the lawn maintenance, all of those utilities are on them. Same thing for a duplex and a quad, although with a quad, you'll have that HOA fee and the lawn fee for the duplex.
Excellent. Excellent. Jim, I don't have any more questions other than that.
Good. Well, the only other question that I know came in right before that I was talking about was insurance. People still don't seem to believe that insurance is as doable as it really is. Just so you know, if there's any confusion, there's a large difference between insuring a new construction home in the areas that we build compared to a low-lying home built in 1952 right next to the beach. These are the homes that insurance companies consider to be too risky, and the premiums show it. Our new construction has to be built at a higher level above sea level than is required. That changed in 2004. So they give us a different, and you also have to build with stronger fasteners, stronger structural design. And when insurance companies go out to assess the risk, that's why we get the lower premium. Because even though we're in coastal areas, we build a few miles inland, we're building on higher ground with stronger structural design and fasteners. So you can save quite a bit of money, as we showed. Like, for example, where I live here on a small barrier island, my home is one off the beach. It's 2004. And my insurance is 7x less than a few houses. And it's only 9 houses wide to the intercoastal where I live. 2 little beach bungalows down there, but they were built in the 1950s, small, nice little houses, but their insurance is 7 times more mine because they're on low-lying ground, different structural design, and they're more of a risk for insurance companies. So remember, insurance companies are all about risk. That's why the new construction actually has an unfair advantage. We have to build differently. We build on higher ground, and it really does show in the premiums that they give us. And that, again, goes right to your cash flow.
So, Jim, we've got a late question just came in from Jay. Jay would like to know, would you recommend creating a separate LLC for each property for each door, or would they consider combining multiple properties in one LLC? Wondering about your strategies.
Sure.
But we'll ask
Great question, Jay. So again, I'm not an accountant. I'm not a tax attorney. I can only talk about me personally. So what I've chosen to do personally, and several of my investor friends, I always qualify in my own name. The banks love my name. They love person. They love individuals. So I always qualify in my own name for the best rate. And after that, I deed the property into an LLC owned by me and my wife for estate planning purposes and tax reasons. And that's something that you can go over with your property counselor, the attorney that we can refer you to. Again, I'm not an attorney or a tax accountant. That's just what I've personally done. I hold more than one property in my LLCs and keep a good umbrella policy over them. Again, that's just the strategy I've chosen. And again, I never own an LLC by myself. And I encourage you, and single member LLC is much easier to penetrate in case there was any sort of legal entanglement. A multi-member LLC, much more difficult. So my wife and I do that together on LLCs that we own, and I qualify in my own name. After closing, I deed the property into one of my LLCs. I will keep more than one property in there. Yes, I keep certain amounts of properties in each one that I own. And I feel good about that protection, tax planning purposes, and I keep an umbrella policy over that as well. Hopefully that's helpful.
And then Jim, for his second part of that question, if you put the LLC on the title, does it impact the loan that is now on our personal names?
And we can send out, my attorney grew up with my wife. She was ranked the #1 attorney in St. Johns County. She's great. Amy came on and explained this. She's a real estate expert, has a vast knowledge. When done properly, this does not. So again, I share what I need to with the bank, and then I hold things how I have to. And Amy goes through that. Again, I'm not an attorney. It does not. What I do add my LLC onto is when it switches onto the title, nothing should be triggered with the bank. Again, you're talking about something due on sale, which is a very, very outside chance, and especially with the St. Germain Act, of being able to, again, I'm not a current attorney or an accountant. St. Germain Act allows us to deed things in for tax planning purposes and estate planning. And that's what I do. And so it should not. What I do always do, and again, we can counsel you through this, is I always add my insurance, to each insurance policy I have, my LLC as the additional insured. So all these little steps, again, guys, we know how to do. We're not accountants, we're not attorneys. We can refer you to it, but I can share with you my personal experience.
Go ahead, Jim.
I just saw 80,000 for a single. How much for a duplex and quad? Austin, you want to jump in?
25% down is the Fannie and Freddie guideline for a duplex and a quad. So what I was telling Zishan was 80K is for a 25% down Central Florida single, but Fannie and Freddie does allow for the 20% down. Single families only. So that could be a little bit less than 80K, maybe around 65, 67,000. Give or take.
So the duplex, though, would probably be more around 125,000 on certain things with that down payment for the duplex or quad. I mean, for a duplex and then the quad, you're looking at a little over 200,000.
Yeah, around depending on what part of Jacksonville they're looking, it could be as high as 300,000. And then I want to say our coastal, our best property, in my opinion, our best duplex that we offer, the Palm Coast duplex, around 160.
There you go. Good. Well, good, guys. Well, we are just about at the top of the hour. Again, the one thing that I'll encourage you, go back. If you want a recording of this, it's going to be sent out. Get a free copy of the book. The principles, the pitfalls that we talk about in here, they were some hard blood, sweat, and tears for us to figure out. Stand on our shoulders, aim for the passive income and active freedom, but follow a system. Don't make this exciting. Follow a system that you understand, that makes sense, that has track record, whatever it is. Of course, we want you to work with us, but that's my best advice for real estate investing. And if you'll just do that and you have that time in the market, the results can be extraordinary. And we've seen this through scores of investors that we've worked with, myself, my partner, my family, our counselors, and we want to see the same for you. So again, we will send you any information that you want. Make sure you ask for a copy of the book. If you don't ask for a copy, we don't know to send it. So please do that. I wish you the best. Thank you for spending an hour of your life to learn about this. We are excited about, we are passionate. We do look forward to hopefully growing your financial future through our model. But either way, we wish you the best. Thanks for joining us tonight. Austin, great job tonight. Thanks for being here. Jaden as well. We'll talk to you guys soon. Thanks for joining us tonight. And please have a great holiday weekend with your family.